Good afternoon, everyone, depending on where you are. My name is Marina Finken. I'm the Making Finance Work for Africa Partnership Coordinator, and it will be my pleasure to moderate this webinar session today. First of all, I want to welcome you and thank you for joining the webinar on behalf of Making Finance Work for Africa Secretariat and all the partners involved in this webinar series, UNEP FI, GCA, AFDB, and the AFAC initiative. As you know, this is the third part of a webinar series that we are organizing on the climate change and the African financial sector, with the objective of fostering a shared understanding on the climate change and to raise awareness around the risk and the opportunity. Indeed, we kicked this webinar series a month ago with a 1-hour session where we discussed the consequences, the implication of the climate change for the global financial sector in Africa. And we also discussed the urgent need for African financial institutions to mitigate the risk and also to seize the opportunities related to climate change in order to support Africa adaptation and transition. The first webinar was also the opportunity for us to introduce the African Financial Alliance on Climate Change and the AFAC, an initiative launched by the African Development Bank in recognition that the African financial sector needs support to endorse its role in Africa adaptation to climate change. After a first focus on the banking industry, this third webinar will focus on the insurance industry. We will discuss different questions. What are the implications of climate change of the African insurance industry? What is the role of insurance group in addressing climate change, both from a mitigation and adaptation point of view? And what are the existing initiatives to support the sector? We will start, so if we move to the next slide, please. Just want to remind some housekeeping rules before we start. So as you have noticed, you are all muted, and we will ask you to keep your microphone disabled for the duration of the webinar. As usual, you will have the opportunity to ask some questions, either via the Q&A button or just by raising your hand after the panel discussion. The webinar is available both in English and in French. You have the option to choose the language you prefer using the interpretation button at the bottom of your Zoom screen. And we will share the presentation and the recording of the webinar within 72 hours following. And of course, please do not forget to complete the questionnaire. It will appear automatically on your screen after the end of the session. I'm going to present the agenda of this webinar. Next slide, please. So after some introduction remarks, I will leave the floor shortly to David Shebar from AFDB for some opening remarks. Then we will have a presentation answering this question today: how is the African insurance industry responding to climate change? The presentation will be made by Diana Jah from UNEP FI. After this content presentation, we will have a panel discussion. I will introduce our panelist lecturer. And of course, we will give you the opportunity to react and to ask a question during the Q&A session before closing the meeting. So I will leave the floor now to David Shebar from Chief Strategy Fund Officer at the African Development Bank for some opening remarks. David, the floor is yours.
Thank you, Marina, and thank you to everyone for joining this webinar today. Actually, Marina's made my job very easy because she's already covered a number of points that I was going to make around this being the third in a 5-part series. So I will be very brief. I would just like to first of all thank everyone for taking the time to join us this morning or this afternoon, depending on where you are. I would also like to thank all our partner institutions, UNEP FI, FSD Africa, the Nairobi Declaration on Sustainable Insurance, and of course, all our colleagues from within the bank who have worked and continue to work with us both on AFAC and this webinar series in particular. So in terms of the African Development Bank, I think as the leading financial institution on the continent, we've made really strong commitments to climate change and to investing in climate finance. The commitment is to invest 25 billion in climate finance by 2025. And we were the first multilateral development bank to meet and indeed exceed the United Nations 50% climate financing target towards climate adaptation. But of course, we do recognize that climate change cannot be addressed by the African Development Bank alone, even with all the partnerships that we have. The key to addressing climate change and the climate finance gap in Africa is working with the African financial sector, both public and private, to ensure that the African financial sector understands the risks and opportunities of climate change. That's number one. Number two is able to have a strong and united voice, if you like, in the international discourse around climate change, to ensure that the rules and regulations, the taxonomies, etc., that are being developed at the international level actually reflect Africa's development needs, so that no one is left behind in the transition. Finally, I think, and I've referred to this before with the bank's commitments, there are huge opportunities around climate finance for the financial sector, and there's a need to actually work together to drive finance to climate resilient projects. So that is why we as the AfDB established the African Financial Alliance on Climate Change, or AFAC, a few years ago. And we are actually in the process of preparing a new strategy for AFAC, which will be launched which we are hoping to launch in September. AFAC is intended to be a platform that is owned and led by the African financial sector to share information, to engage in advocacy and design systems that are appropriate for the African context. And under AFAC, we are working with a number of organizations, some of which are represented here, UNEP-FI, the GCA, and also the Nairobi Declaration on Sustainable Insurance. On the side of the AfDB, I think what I will say is that we are committed to supporting the African financial sector at all levels to be able to identify and manage the risks associated with climate change, but also to take full advantage of the opportunities that the transition covers. So this webinar and this webinar series and the work that we are doing under AFAC must be seen in that context. So with that, I look forward to the discussion today. We're having a deep dive into the insurance industry in Africa and how they are coping with climate change, both from a risk and opportunities perspective. So I look forward to a robust discussion and to learning a lot in the next hour. Thank you very much. Back to you, Marina.
Thank you very much, David. And so without further ado, let's start the webinar with the content presentation. If we can move to the next slide. So I will leave the floor now to Diana Diaz, Program Supervisor for Principal on Sustainable.
Hello, everyone. Thank you so much for the invitation to participate in this event. And thank you, Marina and David, for framing the conversation in such a nice way. It's really a timely conversation to have. And today I'm honored to be here to talk about the insurance aspect of climate change. So as Marina said, I'm Diana Diaz. I am the program supervisor of the Principles for Sustainable Insurance, which is the largest collaboration between the insurance industry and the United Nations. Today, I'm going to talk about a variety of topics. Most importantly, why should the insurance industry care about climate change? What are some of the initiatives from the industry? And then finally, a conclusion and call to action for everyone who is attending the webinar today. So let's start by understanding what is climate change and what is the relevance for the insurance industry. I'm not going to go into many details about the impacts of climate change because my colleagues have made an extraordinary job highlighting the outcomes of the IPCC report, as well as the financing needs for climate mitigation and adaptation. So I would encourage everyone to watch the previous webinars to understand a bit more about those impacts in the region. However, I wanted to highlight a number of observed impacts and projected risks from the IPCC report that are really important for the insurance industry to consider. And those include an increase in the number of heat waves, an increase in droughts, an increased exposure to flooding, the disappearance of glaciers, and heat waves across the ocean. In addition to that, we have a number of extreme hydrological variability, which is projected to amplify in all climate change scenarios. Another very important factor that I would like to highlight is the reduction in agricultural productivity, which is expected to decline by 42% for West Africa by 2050. Climate change also poses a significant threat to African marine and freshwater fisheries, and we know that fisheries provide the main source of protein for 200 million people in Africa and also supports the livelihoods of over 12 million people in the continent. So a very important risk that we need to be careful about. In addition to that, we can also see a reduction in the economic growth of the region, which has already happened due to climate change. But in addition to that, we will see many more impacts in the economy. And not only that, but we will also see some impacts on people, with more people being exposed to climate hazards and also more people suffering from climate migration. Only in 2018 and 2019, we saw over 2 million people who were displaced due to weather-related events. So really important to look out for these observed impacts and projected risks for all the population in the region. However, how does it affect the insurance industry in Africa? These risks translate into different risks for the insurance industry or financial risks that can be categorized into three. Physical risks, which emerge from events such as floods, cyclones, fires, and affect assets, people, and result from a combination of hazard, vulnerability, and exposure. In the second category, we find transition risks, which happen when there is a misalignment between the strategy of the organization and the regulatory changes. And so when there are differences in the transition policies of the organization itself or of the insurance company, and the changes that the economy itself is experiencing, or given regulatory changes, there is an increase in this kind of transition risks. And finally, litigation risks, which might result from insurance businesses being exposed to litigation because of their negative impacts on climate. This physical, transition, and litigation risks can materialize in a number of ways. So we can see already impacts in the economy, with a projected decrease in GDP per capita for all countries across Africa in a scenario of 4 degrees increase. We can also see a number of impacts regarding a growth in global natural catastrophe insured losses, which has been growing between 5 and 7% in the last few years. And this is because the severity of extreme events is increasing, and therefore insurance companies are having to cover higher amounts and insure higher amounts during the claims processes. But not only property and casualty is being impacted, we can also see impacts on life and health, and impacts for life and health insurers. So we can see that climate change leads to a number of issues in this area, such as infectious diseases, an increase in antimicrobial resistance, pollution, issues with nutrition, mental health, as well as mortality and morbidity resulting from extreme weather events. And this materializes for the life and health insurance industry in a number of ways. In the ESG for managing risks in the life and health insurance industry produced by the PSI last year, we identified that climate change has an impact on a variety of underwriting risks, such as mortality, longevity, morbidity, and hospitalization to a high degree when we think about physical risks, and to a medium degree when we think about air pollution, greenhouse gas emissions, and transition risks. But how can the insurance industry address climate change? What are the actions that insurers can take in this area? So there are 3 roles that the insurance industry has, and 3 roles that they can play to support climate change action. The first one is the risk manager role. In this role, insurers need to understand, prevent, reduce, and transfer climate-related risks. The second role is the investor role. In this area, insurers need to redirect finance and funds towards climate mitigation and adaptation. And finally, we have the insurer role, or risk carrier role, where insurers play a role in enabling activities that might contribute positively or negatively to climate change. In that sense, I'm just going to talk about 2 particular actions that insurers can take. One is in the area of climate change mitigation, and then we will look at climate change adaptation. In climate change mitigation, we know that we need to limit global warming to 1.5 degrees. This is absolutely necessary to minimize the amount of impacts that are deriving from global warming and an increase in temperatures. The African continent doesn't contribute as much in terms of GHG emissions. However, there is still a responsibility to contribute to net zero transition. In this sense, I wanted to share with you the theory of change that was envisaged in the report Ensuring the Net Zero Transition, Evolving Thinking and Practices produced by the PSI, where we tried to explain what is the role that insurers can play in climate change mitigation, because traditionally insurance has been looked at from the point of view of adaptation and resilience, but there is also a role to play when it comes to the net zero transition. In that sense, the theory of change says that insurers can have an influence by working with the real economy and helping the real economy reduce their emissions. And they can do that in a variety of ways. So the first key action is abatement of emissions, so reduction of the emissions. And what are some of the actions that insurers can take in this area? So first, thinking about new underwriting criteria for businesses or activities that are GHG intensive. They can also work with clients to help them in the transition. So how do you engage with your clients and support them in implementing their own transition plans? Because that's the way in which you really achieve reduction in the real economy. There is also a role for insurers to play in recognizing the emissions associated to the life cycle of certain projects that they insure or certain services that they provide as well. So the focus to achieve net zero insurance is really in emissions reduction or abatement, and that's the first area, that's the priority. However, there are other actions that insurers can also take. One of those is neutralization, and that refers to removing carbon from the atmosphere. So a consideration for insurers to have is, for example, developing new insurance products and services for negative emissions technologies. So there is an opportunity side in this area. Another aspect to consider is compensation. So that refers to measures that company can take to prevent, reduce, or eliminate sources of GHG outside of their value chain. Now that we talked about mitigation, I want to talk a little bit about adaptation. And there has been a lot more research and knowledge about this area, so I won't really go into detail about this, but wanted to share a number of facts about the region and about the challenges that the region is experiencing when it comes to climate change adaptation. So first, we need to highlight major barriers that are technological, institutional, and financing factors for adaptation. We need to consider also equity-based adaptation approaches that are also gender sensitive and reduce the vulnerability for marginalized groups. Third, we need to consider African indigenous knowledge and local knowledge systems when we are providing adaptation actions and solutions. There is also a need to consider early warning systems based on targeted climate services. And finally, we need to consider risk-sensitive infrastructure delivery. But what does that mean for insurers? What are some specific actions that insurers can take to support climate change adaptation? The first one is risk assessment and management. So we know insurers assess and analyze climate-related risks, and in that way, with all that knowledge and all the tools that you provide, you can help individuals, businesses, and governments to understand their exposure to climate hazards. Another way of contributing to climate change adaptation is through the underwriting activities. And this can be through offering specialized insurance products that cover climate-related risks, such as property damage, extreme weather events, crop losses, infrastructure damage, and others. Another way is through data and research. So you have access to a lot of data and risk modeling capabilities, which you can use to work with other stakeholders, including scientific research, climate scientists, to enhance the understanding of society at a whole to understand climate risks. Another initiative can be through risk mitigation incentives. So there are many ways in which insurers can incentivize risk reduction and adaptation measures through their underwriting practices, for example, through better pricing of risks. Another way is through partnerships and advocacy, where insurers can collaborate with governments, international organizations, and different stakeholders to address climate change challenges. Finally, as a risk transfer and pooling mechanism itself, insurers can facilitate risk transfer and create certain mechanisms such as catastrophe bonds, insurance-linked securities, to distribute those climate-related risks across a broader spectrum. So with that, I'm going to move on to some of the initiatives that already exist in the insurance industry, many of them hosted by the PSI and UNEP-FI, regarding climate change, both on the mitigation and the adaptation side. And I want to start by explaining what is the PSI, so everyone is familiar with the framework. So the Principles for Sustainable Insurance serves as a global framework for the insurance industry to address environmental, social, and governance risks and opportunities. The vision is of a risk-aware world where the insurance industry can play its full role in enabling a healthy, safe, resilient, and sustainable society. And our purpose is to better understand, prevent, and reduce ESG risks and to better manage the opportunities that are associated. We are the largest collaboration between the insurance industry and the United Nations with over 250 members, including signatory companies, which are insurers, reinsurers, brokers, service providers, and others. And we also have over 100 supporting institutions, which include insurance associations, regulators, supervisors, civil society organizations. The PSI is built on the basis of 4 principles. Principle 1 is about embedding ESG issues in the decision-making of the insurance business. The second principle is about working together with clients and business partners to raise awareness about ESG issues. The third principle is about working together with governments, regulators, and other key stakeholders to promote widespread action. And the fourth principle is about demonstrating accountability and transparency by disclosing progress in implementing the principles. The PSI hosts a variety of initiatives in different areas, including ESG risk management, climate change, nature and biodiversity, reporting, and also the achievement of the SDGs. I'm going to start by presenting the work of the Net Zero Insurance Alliance, which is an initiative that is aiming at transitioning underwriting activities to net zero emissions by 2050, consistent with a maximum temperature rise of 1.5 degrees. This alliance has produced 2 very key standards that I would like to share today. The first one is the Insurance Associated Emissions Standard, which was created in partnership with PCAF, the Partnership for Carbon Accounting Financials. The standard is the first global standard which allows the insurance industry to measure insurance-associated emissions in their underwriting portfolios. So many of the initiatives that I am going to talk about today are focusing on the underwriting side, just for clarity. This standard provides a number of formulas which allows insurers to calculate what are the emissions associated to their underwriting portfolios, particularly for commercial lines and within personal lines for motor. The second output from the NZIA that I wanted to highlight is the target setting protocol. The NZIA target setting protocol is a guide for insurers to set targets, which allows them to transition their underwriting portfolios to net zero. The target setting protocol provides 3 different categories of targets. One of those is the emissions reduction targets, which provides the opportunity of setting 2 types of targets. One of those is setting an overarching emissions reduction target. So that's a range that you can set in your underwriting portfolios. And the second one is using the sectoral decarbonization approach from SBTI. The second category of targets are the engagement targets. And within that category, we can find 2 types of targets that can be set by insurers. The first one is the portfolio coverage approach, which is also linked to SBTI, which is looking at what percentage of the portfolio, which percentage of the clients in your portfolio have transition plans. And the second type of target in that category is the focused engagement target, which looks at engaging with the most intensive GHG clients in your portfolio and supporting them in the transition. Finally, we have the category of ensuring the transition targets. And this refers to offering insurance or insurance products or services for climate solutions. And climate solutions are those activities that contribute towards climate change mitigation or a combination of climate change adaptation and mitigation. So with that, if you want more information about the NSET, I am, of course, happy to provide it. The slides will be available, and the organizers can circulate them as well. Moving on, I want to mention the work of the V20 Sustainable Insurance Facility. This is a project pipeline facility hosted by the PSI, and the objective of the V20 CIF is to support the development and availability of climate-smart insurance solutions for MSMEs in the most vulnerable economies to climate change, many of which are actually in the African continent. Some of the activities of the V20 Sustainable Insurance Facility relate to identifying different projects in the region which can be supported by the governments of the V20 as well as supported by other donors, and identifying implementation measures for those proposals. My colleague Diana, who will be joining the panel, will be able to share a bit more information about the activities of the V20 CIF. The next initiative that I wanted to highlight is the Nairobi Declaration. The Nairobi Declaration on Sustainable Insurance is an initiative that was formally launched at the PSI African event in 2021, and it's basically a translation of the principles for sustainable insurance in the African continent. It's a commitment by the African insurance market to support the achievement of the Sustainable Development Goals and transition to a more sustainable market. There are different actions that insurers commit to when they sign the Nairobi Declaration. And those actions are across risk management, insurance, investment, policy, regulatory and industry engagement, sustainable insurance thinking and practices. The Nairobi Declaration is now also supported by FSD Africa, and my colleague Kelvin will be talking a bit more about the different activities of the Nairobi Declaration, but I would encourage everyone who is attending the webinar to really sign this declaration because it's an initial entry point to understanding sustainable insurance in the context of the region. Finally, I wanted to highlight the African Climate Risk Facility, which is an outcome of the Nairobi Declaration, actually. And this was announced during COP27, and it's a first ever financial commitment by the African insurance industry to underwrite 14 billion of cover for Africa's climate-related risks by 2030. So a very important facility that is being developed and a very important opportunity for anyone who is attending the webinar today. I know we are short on time, so I'm just going to close with a call to action. And I'm going to finish with a set of 5 action points for the African insurance industry for anyone who is listening today. The first point is 1.5 degrees is the global goal, not 2 degrees. Everyone needs to commit to science-based net zero insurance and investment strategies and targets. Cutting emissions in health by 2030 is the first priority. Second, supporting adaptation and resilience in the region. We need to commit to protecting individuals and communities from the impacts of climate change, reducing risk disaster, tackling loss and damage, and building resilience is fundamental. Third, protecting the most vulnerable and leaving no one behind is indispensable. We need to close the protection gap in the continent, and we need to consider the needs of the most vulnerable. Fourth, health is our greatest wealth. We often forget that life and health insurers also have a role to play in the transition. So we need to consider what are the actions that they can take both on the adaptation and the mitigation side. And finally, systems change is required to overcome unsustainable development. The entire insurance industry value chain, along with insurance associations and regulators, must make sustainability an integral part of decision-making. So with that, I'm going to close, and I thank you everyone for your time and your attention.
Thank you very much, Diana, for the very insightful presentation. As presented at the beginning of the webinar, we are going to go to the webinar with a panel discussion, and then we will be more than happy to answer your questions. Please keep in mind that you can write your question anytime using the Q&A feature. So first of all, let me take a few minutes to welcome and introduce our panelists today, and then we will start. So first of all, we have Diana just present us the V20 Sustainable Insurance Facility. And so in the panel session, we have Diana Chepenigo, who is the Africa Regional Coordinator for this facility in Africa. Kelvin Massingham is the Director of Risk and Resilience at AFD Africa. And unfortunately, due to some technical issue, Leslie won't be able to join today. He's the Chief Executive Officer at African Risk Capacity, which is an insurance company specialized in providing parametric insurance coverage against natural catastrophes. But unfortunately, they won't be able to join today. So again, welcome Diana and Kelvin, and thank you very much for joining this webinar today. So my first question will be for Kelvin. So during Diana presentation, we understand very well that the climate change and the worsening effects in Africa affect the business of insurance group, and this was also revealed in a global survey in 2019, who found that 72% of insurance companies actually believe that climate change will affect their business, but very few of these companies have taken significant steps to lessen the climate risk. In your opinion, and given your experience in building resilience within AFD Africa, what do you think are the main barriers insurance groups are facing, especially in Africans, to well manage the risk they are facing?
Thanks, Marina, and good afternoon and good morning to all of you. Thanks for the invitation to participate. Yeah, so we do a lot of work as FST Africa and also through the Nairobi Declaration on Sustainable Insurance with the African insurance industry. Nairobi Declaration now has around 120 insurance signatories across the continent, and so we're very much engaged on this issue. And maybe if we just pan out a bit, I think the first and biggest issue is leadership. And so if an insurance organization is going to take sustainability and climate change in particular seriously, then there needs to be buy-in from the senior leadership and incorporation of that into strategy and into governance and setting targets and those type of things. And at the moment, for the majority of African insurance leaders, it's not a priority topic. And so I think it starts with getting leaders on board that this is both a serious long-term risk to their businesses, but also a serious opportunity to take advantage of. So that's, I think, the first thing. So there's a group of insurers for which this is not really on the agenda, which needs to be overcome. I think for those that are bought in, for which where leaders are prioritizing sustainability within the business and prioritizing dealing with climate change, I think a big challenge is capacity. So what you find is that there's low levels of technical understanding and knowledge that exist within the African insurance industry on this topic. And so whether that's the risk management teams, whether it's the sustainability teams, if they have them, the actuarial teams, there's a really limited knowledge. And so that needs to be built up. And so, initiatives like PSI and the Nairobi Declaration of Sustainable Insurance, AFAC, are really trying to tackle this capacity challenge and really work with the industry to build the knowledge that is necessary. And that is for both the sort of outside-in risks, the dependencies on climate change that the insurers will face. This is the kind of things that Diana was talking about, where physical and transition risk will impact both the sort of the underwriting performance of insurers, but also their investment returns. And there, it's really important to be able to understand climate scenarios, to be able to understand the different degree pathways that may materialize in the future, to understand transition pathways as policy and regulation and consumer preferences change over time, and then to be able to model the impact of those on your business. And so essentially to do stress tests under those different scenarios to see how the business will perform, which will help you to understand the main risks, but also some of the opportunities. And I think a key thing in getting African insurers to respond is actually the opportunity side. So it's not just about outside in kind of dependencies, but it's also about how you as an insurer can contribute, can impact both adaptation and mitigation. And there, I think there's very significant opportunities for insurers, as in those three roles that Diana was just talking about, in contributing to the transition and to resilience. And we can double click a bit more on those opportunities, but we find that if you just keep the conversation to the risk management side and to sort of managing the outside impact on the insurer of climate change, you get limited kind of traction. But as soon as you start talking more about the opportunities, and there'll be winners and losers as we transition to a low carbon economy, that you get much more attention, especially from senior executives.
Thank you. Thank you very much, Kevin. And indeed, we will have the opportunity to discuss further more about the different opportunities. So you understand very well the barriers that you mentioned for insurance group to actually manage the risk they are facing on their business. And if you have risk on the insurance group part, so that also means that Africa population, whether the business, the companies, and the person needs more protection. And as one of the opportunity, and Diana also mentioned it during the presentation, there is a need for more insurance project to actually offer the protection to this vulnerable population. And I think that is the insurer role that Diana mentioned during the presentation. And then I will turn now to Diana and to ask her more about the work of the V20 facility, which aims to promote the insurance solution in Africa. And Diana, are you already observing kind of new insurance projects and initiatives being put in place in Africa to offer more protection to the population and the SMEs as you are aiming at the V20 facility?
Thank you, Marina. V20, as mentioned by Diana, Sustainable Insurance Facility is keen on providing solutions, developing solutions specifically for the micro and SME sector. And we cannot belabor so much about the role the MSME plays in our continent. A bulk of our employed people actually fall within the MSME sector. And so it's a source of livelihoods. So if we can provide solutions for that category of enterprises, then we are able to sort out solutions for a larger population. So some of the products and initiatives that are being undertaken and are still, it's an ongoing process being done by V20 SIF and many other players in the market. And we've seen that coming up. Some of the key products, like the weather index-based products, are solutions which are addressing the impact of climate change. And probably what I would want to highlight is most of the solutions we've all seen or heard of are more of dealing with the impacts of the climate change. So we've seen the weather indexed ones, we've seen the parametric insurances. And what I would want to do, or what we want to do as SIF V20, is to also look at the flip side. And this is what we'd want to encourage most insurers and reinsurers in Africa as well, to start looking at adaptation more than mitigation. Yes, we are dealing with the mitigation at this point, but we need to start thinking long-term as well. So I know most of the weather-related risk and climate risk are touching on the agriculture sector, and that's where the solutions have mostly been coined around. But we need to start stepping outside that box and thinking outside just agriculture-related. Yes, we have those solutions. Can we start coining something like motorbikes, for example? Let me just give a practical example, because this is something most of us in Africa can identify with. The source of transport for most of our people is motorbikes. Deliveries done motorbikes. And if you visit most of the countries in Africa, most of the people are using motorbikes, and it's become a major source of logistics and transport. Now, how can we coin a product then as insurance companies to deliver a solution that has an impact on our environment? So one, can we start promoting insurances for electric bikes instead of fossil fuel driven motorbikes? And that's the angle we need to start thinking of. How do we then bundle those solutions to encourage more people to transition from using fossil fuel motorbikes to electric motorbikes? And within our portfolios, how do we push for that? Because I'm sure every insurer has motorbikes in their books. So by bundling it in a way that it's a win-win for everyone, that's how SIF comes in. So V20 tries to structure something that ensures that, one, it makes business sense for the insurer as well, and two, that it adds value to the micro or SME space who is going to be deriving solutions from that, that product, and to identify who are the partnerships we're going to work with to deliver that project, whether involving the government or some demand aggregators along the way, or any technical expertise along the way. And then, of course, providing funding to push that solution. The other angle that we need to be looking at as insurers, because most of the time you'll hear insurers shying off from some risk because either it's not making any underwriting profits, so it's a loss-making product. Why would I participate in it? But how can we coin it in a way that, one, it makes business sense for the insurer in terms of either economies of scale? And so do we bring on board other partners, like in the case for motorbikes? Can we derive carbon credits from for the motorbikes that are being insured, such that then it will help, one, to pay off the insurance, to pay for premiums for the insurance, to have accessibility of other products for these micro SMEs, for example, health insurance. So the carbon credits can pay for their health insurance or personal accident, and many other forms of insurance. So we'll be utilizing what is available to actually provide a solution, a wholesome solution to the micro and SME space. So we need to start thinking in those wider perspectives as the insurance industry, because the impact by that motorbike, for example, would be to reduce the emissions in the environment. By reducing the emissions in the environment, what are we doing is we are dealing and slowly resetting the clock for the environment, and so reduce the impact of these losses we are seeing right now in our books. The other key initiative that we'll be pushing for, and I think I've just encompassed in that summary, is the key use of collaboration and public and private partnerships. I think that is very important, and that's what we will be leveraging on as SIF to find out who are having what strengths and which of the players we can put together for the benefit of the insurance industry to be able to deliver the solutions to the micro and SME space. So that is very relevant. And I'll just this famous caption, or rather wording from my tribe, which my grandmother used to speak about. She used to say, and I'll translate that for the benefit of everyone. Is, in the African setup, we used to have ports, and the ports would be for it to be stand upright in the store, you have to put another port next to it. So several ports will stand next to each other to support each other to be upright. And that's what we are trying to achieve with SIF, is put together the right partnerships to support each other to deliver solutions for the micro and SME space.
Thank you very much, Diana. So I understand that the need indeed to have a broader picture and also a long-term view on the instrument. So because Kelvin mentioned the opportunities, we need to think not only about the risk, but also about the opportunity, not only to think short-term, but also long-term, but not only about adaptation, but actually to transition. And maybe that is where we can find some opportunity which will make sense from a business point of view for insurance group to actually support Africa's adaptation and transition. And so we discussed also what you said, which is really important, is the need to foster partnership. And this webinar, I think, is one of the examples, because many institutions are involved. We presented some key initiatives, the AFAC, the UNEP, we are all working together. And I just want to hear the Kelvin point of view on that, this need of a partnership. Do you also identify it as a lever to actually to make the insurance, the African insurance sector more able to support Africa's transition and adaptation to climate change?
Thanks, Marina. Yeah, so I think absolutely partnerships are key. I mean, we're tackling a big global crisis that affects all of us, and you know, in a sense, it's an existential crisis, and so it's not a situation in which we need to be siloed and competitive, but we each have a responsibility. And it's particularly insurers as holders of large amounts of capital, as leaders in the financial sector, have a responsibility to to solve this, and as Africans we have a responsibility to deal with the vulnerability that the continent faces. And so we cannot do this as individual companies or individual organizations, and so it requires partnerships and collaboration. I think that's the heart of the initiatives that you're hearing about today. So whether it's UNEP PSI, whether it's sustainable, the V20 facility, Nairobi Declaration, Sustainable Insurance, AFAC, and all the partners that are on this call, we're working together towards a common goal to tackle this crisis, and I think that's really important. And in all of these sort of collaboration platforms, there's peer learning that needs to happen. We're all on a journey to grow in our knowledge and awareness, and to understand the practical actions that we can take. And it needs to obviously be practical actions that are taken, and so we can learn from each other. We can leverage the strengths of each other, and I think it also needs to be we need to look broader than just us as the insurance industry, and I know that's the main focus here. And there was a question in the Q&A about collaboration with the banking opportunity. I think as as a financial sector as a whole, and I know that's AFAC's focus, we need to be working together, that as capital is deployed, and whatever role you play in the capital stack, that we're aligned on kind of tackling climate change and the sustainability challenges that we face. So absolutely, 100%, let's work together more.
Thank you very much, Kelvin. In Diana's presentation, Diana Diaz this time, she mentioned three roles of the insurance group: the risk management roles, the insurer roles that we discussed in this first round of questions. But she also mentioned the investor roles of insurance group, the role that they have to make sure that funds will be redirected to tackle the climate change. And I want to ask you both about if we discuss specifically about the investor roles of the insurance and the insurance group. What are you observing now? What do you think are the main challenges and opportunity? Because we discussed in the first webinar the huge investment opportunity for African financial institutions. So what are you observing now, and what will be, in your opinion, against the key barrier for insurance African group to actually seize these investment opportunities? So we can start with you, Kelvin, and then we will hear from Diana.
Sure, thanks. Yeah, so I think there is obviously a very large amount of capital that is owned by insurance companies on the continent. And if you include pension funds as well, it's very, very substantial institutional capital. And that needs to be deployed increasingly towards green pathways. And at the moment, I think the challenge is that most insurance companies in Africa rely on the investment income to make profit. They don't make large underwriting profits, or in many cases underwriting losses, and so the investment income that they make is very important, and so they're highly risk averse in the way that they invest that. The other dynamic that you have is that you have government securities in most African countries which provide very high yields, and so you have a close to risk-free high yield return in government securities, and for that reason the majority of insurance investment at the moment goes into government fixed income, 60 to 70% of the portfolio. Then you have around 10% that's in property, and a very low amount that's kind of in equity markets. And so that really is a structural problem. There's also a lack of green investment opportunities on the continent. So the main ones at the moment are green bonds. And so there have been, around 10 to 15 sovereign green bond issues. But that's a very small amount. They've all been oversubscribed. And so, that's a limited sort of sovereign fixed income opportunity. There have also been some corporate green bond issues, but those are generally not investment grade for insurance companies or too low ticket size. And so you're faced with a very kind of limited spectrum of investment opportunities if you want to go green. On the equity side, the listed companies in Africa tend to not really represent the real economy very well. It's largely sort of banks and telcos that are listed on the stock exchanges. So at the moment, there's very limited opportunities as the bottom line if you want to go green with your portfolio. But I think that also then represents an opportunity, because if you as an insurance company were to take the lead in creating a regional or a domestic ESG fund, a green fund, I think you find that there's this huge amount of demand for those investment opportunities, because they just don't exist at the moment. And many insurance companies are looking to try and green their portfolio and are facing pressure from their shareholders and from their customers to do so. So I think that is a significant and obvious opportunity for the industry.
Thank you very much, Kelvin. Diana, you want to share your point of view on that question?
Yes. I think Kelvin has, of course, covered a wide area of some of the inhibitors for investments in sustainable investments assets. I think the two which I would want to highlight is one on data and the metrics. I think what has been there as a gap is there's no standardized, reliable data for use by insurance companies to do their comparatives before they settle on an investment opportunity that is ESG compliant. I think that would be a major inhibitor, and maybe something that we need to address then going forward. Then how do we have standardized data to enable them make informed decisions on what investments they can go to, which are ESG compliant. The second and most key also is on the regulatory framework. What incentives are the governments giving for companies to invest in ESG compliant assets? So that has not really gotten to the levels that we want. Well, it's understandable that this is still a new area when it comes to focusing on investments which are ESG compliant, but what incentives are the various governments in Africa doing to also push people to invest more on sustainable investment? So I think there's a role the governments have to play also to push that agenda.
Okay, perfect. Thank you both. And one last question, because you both represent the African point of view of international initiative, the V20 and as Diana said, the creation of sustainable finance is like the African initiative for the PSI, and also the AFAC initiative, as you know, aims to support an African voice, because the debate and discussion about climate change and the financial sector is gaining momentum internationally. There is a lot of discussion, and given your experience on these two African initiative, what do you think are the specificities of the African insurance sector which needs to be highlighted in the international debate?
For Africa, what are the specificities for Africa? I think the one and major, which has been discussed over and over again, is of course our susceptibility to climate risks. Drought, floods, storms have hit our continent many a times on different regions. And what is the impact on that on the insurance companies? Of course, what has happened is because of the high risk which those climate change risk emanating, is insurance companies are paying out more claims, which in essence leads to less profitable books, and that means instability by insurance companies. So that has been unique and more specific for Africa. And the net impact of that is on product viability as well. And I mentioned before that insurance companies would be hesitant to touch some risk because of the impact on their books. So, and you'll find, like agricultural risk, not many players are playing in that field because they're worried about how it will affect or have the net effect on their books. The second most critical thing, or which is unique about Africa, is we are agriculture based. So most livelihoods in Africa are reliant on agriculture, which most of the cases are actually rain-fed. So ideally, that means then the climate changes has a direct impact on the source of livelihoods, and two, the risks that are being insured by the insurers, which again, as I said, affects the viability of some of the products. Another key thing which is more specific to Africa is on capacity building, and Kelvin has mentioned this before, and we cannot overemphasize that. We still have lots and lots of room for improvement when it comes to capacity building. A key example is on modeling of climate risks. We have very few players who are able to do the modeling. And then what is also lacking is how then can we take up the research on the various sectors which are affected by climate change, and then how do we marry together the models or the climate data with these exposures to now help us do the pricing of risks and do our underwriting. I think that is still posing a big challenge, and that is an area that needs a lot of improvement for the African continent.
Thank you, Diana. Kelvin, you want to share some feedback on this as well?
Sure. So I think, you know, the African insurance industry has a very important leadership role to play on the global stage in influencing the agenda. And maybe you can just mention two things, and you know, Diana's already mentioned some. So I think one is on the loss and damage conversation, because loss and damage, the impacts that are already baked in from climate change are disproportionately affect Africa. Africa is the most vulnerable continent, and you know, the loss and damage conversation up until now has largely been about, you know, reparation, about compensation from the global north towards Africa, and that's appropriate and needs to continue. But I think that's never going to fully deal with the scale of the impact and the vulnerability that we need to deal with. And so, you know, as insurers in Africa, we have one of the key financial solutions to developing resilience to you know, these frequent and intense climate events, climate disasters that happen, because insurance provides, you know, a cover for the catastrophic tail end risk of these big disasters. And so, you know, I think advocating that the private sector insurance companies in Africa have a key role to play in deploying their capital to to underwrite these risks and to provide the social protection that's needed, I think is key. And that was really behind the signatories of the Nairobi Declaration at COP27, making this ambitious commitment, which Diana mentioned in her presentation, of the Africa Climate Risk Facility, to underwrite 14 billion of climate cover by 2030 for sovereigns, for the most vulnerable on the continent. And that's really a commitment to put their balance sheets towards solving this problem and putting private capital into the loss and damage conversation. And so I think that's important. We need the 100 billion and more conversation to continue, but we also need the private sector and the insurance industry particularly to stand up and say, we're willing to solve this problem ourselves. We're on Africa the ones that are affected by this, and so we're providing the solutions. So I think that's an important narrative in the whole loss and damage conversation that we can contribute to. I think secondly is influencing global frameworks. And so in the past, I think there has been often a tendency for frameworks to be developed in the global north and not to be fit for purpose on the continent or in the developing world. And so we need to ensure that there's an African voice in the development of these frameworks. And so, for example, on the Task Force for Nature-related Financial Disclosures, the nature equivalent of the TCFD, that's a beta framework which is currently being iterated. And we have a number of African insurers and banks that are providing feedback into that TNFD framework to ensure that it's appropriate for the continent. I think the other thing is that once frameworks have been developed, that they also need to be applied in an appropriate way for Africa, recognizing the constraints and challenges on the continent. And that's also something that, as the Nairobi Declaration, the working groups of the Nairobi Declaration are working on, things like an ESG taxonomy that's for insurance industry in Africa that's relevant, ESG roadmaps and guidance for African insurers that want to move forward on this journey, that takes the input from these global frameworks, but then contextualizes it for the African context. So I think there are some things that are unique that we face and that need to be taken into account on the global stage, and we have a very important voice in influencing that.
Thank you, Kevin. I will open now the floor to the participants. We have many questions on the Q&A. And just to remind, you can also raise your hand, and then I will just invite you to unmute yourself and ask your question. So let's start with the question in the chat. So both of you, Kelvin and Diana, mentioned as a challenge, let's say, the leadership involvement and the awareness on climate change. And we have a question here from Asandashi. What can be done to quickly inform or update the industry leadership and upskill the underwriting levels as well?
I'm happy to take a first go at that. So I think that it's an important question, and there's no, I think, quick fixes. I think that joining some of these collaborative forums, like Nairobi Declaration or UNEP PSI, is a excellent way to start on the journey, because they involve webinars, knowledge sharing, peer exchange platforms that enable capacity building, but also importantly allow for piloting and testing out of these approaches within the organization and support for doing that. And so that, I think, is a key way to start, is to actually start taking action within your organization, start piloting and learning as you do. And so I think rather than going the journey alone, I think a key thing is kind of joining these collaborative platforms that are already working to achieve that. I think obviously there's a place for professional development and training and going on courses and that type of thing. And I think there's some excellent courses which can help with that.
Allow me to chip in as well on that. I'm sure in every country there are associations for the industry. And I think in Africa, we have several of them. We have the Africa AIO, and we have knowledge sharing platforms where we discuss and share with the rest of the industry on what are the developments with sustainable insurance. I think the players need to take advantage, and this should be led by the associations, but they should always strive to participate in the knowledge sharing roundtables or platforms so that they can get to know what are the developments and what's happening in the space of sustainable insurance. The regulators are key as well. And probably, I think I've seen a question from somebody on what is the role of regulators as well in this discussion. And I think that's the direction we need to go. The regulators need to also set pace, be the leaders in terms of these discussions so that the rest of the industry can be able to flow along in the different regions of this continent.
Thank you, Dana. Indeed, we have a lot of questions on the regulatory. Just to know, in our webinar series, we are planning to have a dedicated webinar to have the point of view of regulator, both from the banking industry and the insurance industry. And I hope it will help answering all these questions. We have a question for you, Diana. What kind of organizations will be supported by the V20 for helping adapt to climate change?
What kind of organizations? We are not limited. We are open. We are open to have discussions and see what you're bringing to the table. As I mentioned earlier, it's about what are the strengths and what are the values, or what value are you bringing on board along the value chain. So we're not restrictive. If there's a way in which you're going to contribute to the solution being developed or the solution arriving to the destined recipient, then we are happy to partner together and deliver the solution. So we are not restricted. So long as you're legal, you're not illegal.
That's important. Thank you. One last question from the Q&A, and then I will open the floor to participants to ask the question there for themselves. How do insurance companies maintain the profitability while transitioning to ESG compliant investments? Can they be supported in the interim?
Perhaps I could respond to that. And let me use an example. And this is common. I think a good example is the DRIVE project. I don't know if any of you are aware. And I think I saw also among the questions, somebody asking if there are any projects happening in Africa. And yes, we have many projects running in Africa. And I will talk about the DRIVE projects. The DRIVE project is a livestock insurance coverage. It's parametric, where livestock is being covered for lack of forage. So it's not about the loss of the livestock, but actually the lack of forage. The forage could be lacking, but the animals have not died, but there will be compensation because there was no forage available. Now, what is key about that product, and it meets most of the specifications I've mentioned earlier in terms of, one, there's a lot of partnership. The project is funded by the World Bank. We have a reinsurer who is acting as the coordinating agency for the project. Two, we have a couple of other reinsurers who are participating on that risk. And then we have several reinsurance companies who are forming the consortium to insure the risk as well. So you can see there's a lot of partnership along the way, as well as the government of the various countries, which is also participating in terms of coordinating the ground access for that product. What is key about that is there are many fundings which are available to minimize on the marketing cost, because one of the things which hits the bottom line for an insurance company in any product is, one, there's the marketing cost, which normally goes to feed into the pricing of the product. There is commissions, which also feeds into that. So by funding being available to even out some of those costs incurred by the insurance companies, and automatically it feeds into the bottom line of that project or pipeline. So in a way, I hope that has answered that question raised on how can such projects come in hand to actually assist the insurance companies.
Thank you, Diana. Kelvin, yes, I was going to invite you to please go ahead.
Yes, actually, I think if I'm not wrong, maybe the focus of that question is more on the investment side and how, as an insurer, if you're moving your investments from more traditional to ESG, that it might be need to compensate on the profitability. So I think that point of view kind of needs to be challenged, that in order to go green or go in an ESG direction means a reduction in your commercial returns. And certainly in the long term, that's definitely not the case. So, I think as we transition to a low carbon economy, you're going to get many, radical repricing in gray industries and in oil and gas intensive industries, and many stranded assets will occur. So, investments that are exposed to those industries are not going to perform well in the long term. And there's growing significant evidence that that green investments, sustainable investments, produce higher returns. And so I think, as insurers, it makes long-term sense to move your portfolio into a more sustainable kind of green areas. And for me personally, like all of my retirement savings is in sustainable investments. And if you're looking to the long term, I think that's the best strategy. So no one's asking any insurer to sacrifice to their shareholders' returns. If it's on that basis, then kind of the transition won't happen. And so I think we need to challenge that notion.
Thank you. So basically, there is no contradiction between profitability and green ESG investment on the long run, on the long term. So we have two participants which raised their hand. So I will invite Michael Shibu to unmute himself and ask his question. Michael, you are still on mute. Okay, he lowers his hand. So then I will invite Cosmas.
Sorry, that was an error. Oh. An error.
Okay, please go ahead, Michael.
I said it was an error. I raised my hand in error.
Okay, the raising was an error. Okay, then I will invite Cosmas Luwanika.
Hello, can you hear me?
Yes, we can hear you very well. Go ahead, please.
All right, thanks for this wonderful gathering. I would like, first of all, to concur with Kelvin. Kevin raised a very important item. I am from Malawi, by the way. In terms of insurers, which I would call traditional insurers, their main focus, like in countries like Malawi, is on investment returns, where the government is borrowing a lot and they're making a lot of money from there. Therefore, to change focus into items like micro insurance and what have you, it becomes a problem, because they're already making a killing from other lines of business. For example, here in my country, we have an inclusive insurance framework, but none, it has been there for about 7 years. None has even wanted to get into that space, because first of all, you can't run. From the experience I've had, you need a bit of a time, 3 years, for an inclusive insurance product to stabilize and start giving returns. So most of them wouldn't want to go into that space. So I did some analysis that was just personal, where I identified that if you look from the banking sector side of business, you would find that microfinance institutions are thriving. While when you go into the insurance sector, micro insurance companies are so limited. Now, I was trying to reason why is this the case, because I believe micro insurance companies would be the ones that would even help in reaching out to more people and doing all these risky climate resilience products and what have you. The problem that I came to identify, for example, in Kenya, the capital requirement would be about $400,000 US. The same like in Malawi, it's around $300,000 US. In South Africa, it's around that for you to get that license. And most likely the people who would want to go into that space are individuals like me, but they do not have the financial capacity to raise the capital. And maybe my take to the panelists there is that there could be some consideration if we really want to penetrate from the insurance point of view into this market by helping some potential establishments that would get a capital and try to be in that space. That is going to work. The second point I have is on partnerships. Our lady there from UN emphasized on partnerships, but partnerships, you need to be aligned. You should have the same common purpose. I've had examples. I've got about a 15 years experience in this. You'd have a partner, while his goal is just to tick boxes that he has got this product, and then he doesn't help you. So when you are doing these kind of partnerships, we need to bring in people who are aligned and have got the same goal. Thank you.
Then, yes, go ahead, Kevin.
So thanks, Cosmos, for those comments. I think, you know, fully agree with you on no one is asking insurance companies to sacrifice commercial viability here, and so or to take risks that they're not comfortable with. And so I think what we're talking about here is moving beyond just what's traditionally been called microinsurance or inclusive insurance as kind of the opportunity set for when you're talking about sustainability. So I think it's much broader than that. We as a global economy are going to be transitioning to low carbon, nature positive, and in that transition, there's going to be many opportunities. And so as we move, for example, into much more renewable energy, there's a need to kind of de-risk renewable energy projects and exploration projects. And so already we're seeing in markets like Kenya and Ethiopia on the geothermal side, huge underwriting opportunities for insurance companies to take some of the early stage development drilling risk. And you know, equivalent opportunities exist in other renewable energy sectors. As carbon credit markets develop, both the project developers and the buyers need insurance products to de-risk the solutions. And banks, as they, and you mentioned microcredit, as they start to lend, and as they lend to particular sectors, they need insurance solutions in the capital stack to make the risk return profile appropriate for them. And so as they're lending for adaptation or mitigation, there's a key role to bundle insurance with those solutions. And so I think there's moving beyond just inclusive insurance, there are significant kind of commercial opportunities for insurers to take advantage of, and I think those that move early and start, are first into the market have a significant advantage in capturing those markets.
I think further to that, I think he's raised also the component on the challenges with the capital requirements for setting up a micro insurance player within the various markets. I would look at it on two fronts. Either one, seek funding to access capital to kick off your operations. And of course, that one means that you must have a justifiable and a good business case to present for you to get funding. The other angle we would look at it is from regulatory perspective. Can the various countries look at minimizing the capital requirement? Again, this could be debated, but can it be more accessible for entities to be able to set up and pursue that space? So again, this is not something that can be answered on this forum. I think it's something which can be addressed outside of this forum. The other item you raised was on partnerships and having the same objectives with the partners you're working with. I think a good way to address that also is having very clear deliverables for each of the partners. So you must have some form of understanding, an MOU in place with very clear deliverables of what each partner is going to be delivering in the value chain. I think that way you can address the issue of objectives be aligned or not aligned.
Thank you very much, Diana. We are getting close of session. May I just ask the panelists if they have a few minutes more, and then we can take another question before closing the webinar. We can go slightly over. Okay, thank you. Then I will invite George Karahash. Sorry if I mispronounced to unmute himself and ask a question.
Hi, Marina. No, I'd actually posted my question online, but that's fine. My question was directed at Diana. She was talking about issues of data, and I wanted just to hear from her what are her thoughts on resolving these data issues, and to what extent does she think private sector entities, there are a lot of private sector firms that are actually involved in data production beyond the statistical offices. Maybe this is an area where we need to do more exploration, and therefore, what are the possibilities of agencies like hers collaborating with us, private firms? And if there are possibilities, I know one or two here in South Africa where I'm sitting that you may want to work with. Thank you.
Thank you, George. Thank you for your question. In terms of data, of course, we are happy to work with any entity that has data. I think the challenge I was bringing up was the standardization of data. Everyone could have data, but how do they collect them? How do they moderate the data? How the final usability, how can we relate your data for your agency compared to another agency? I think that's where the challenge is. In terms of who to work with in terms of data, we are open to see what your entity has to provide and see if it works well for what we are driving at. And I'm sure I can see Leslie is back online. Good to see you, Leslie. I'm sure Leslie would want to shed more light also on that aspect on data, because I know he's dealt a lot with that from his capacity within ARC.
Thank you very much for that, Diana. So for us as an insurance company running parametric insurance, our insurance programs are based on modeling of losses. So when, for example, there's a drought or there's a flood, we're able to model, I think, with a high degree of accuracy, what the size of the loss is. The advantage of using this parametric approach is that then we're able to pay claims very quickly. We pay claims within 3 or 4 days of an event happening, meaning that we provide the first liquidity for a government, a municipality, a corporate to be able to respond. However, as you can see, right, the bedrock of all of this is just based on the quality of data, because poor quality data will undermine the customer's confidence in the product. We have a public-private sector approach to this, because the raw data in itself comes from satellites. So it's provided by TEMSAT in Europe as an example, by NASA in the US as an example. And then we cross-reference this data to publicly available data from meteorological organizations, so for rainfall, for wind speed, and also for river levels in the case of a flood. We then are able to then translate this raw data into algorithms that help us with the modeling. And of course, in Africa, we then have generally poor collection of data, because then the process then of reconciling the satellite observations to the ground observations is not robust. And of course, if there are organizations, institutions, or individuals with an interest in this, we're always happy to collaborate. In fact, we have collaboration with a number of universities already around this data point, and we'll be happy to work with a lot more people, because the scale of the problem that we're trying to solve is such that it requires the contribution of as many people as possible.
Okay, so can I quickly come in then, and then I will lower my hand then. So I actually sit in the ADB sub-regional office, and I suspect, Leslie, you are here in Johannesburg, huh?
Yes, that is correct.
Okay, from the way, from your accent, I thought you were South African. Yeah, so I'm actually sitting just across from the South African Weather Service, but I work for the ADB. So what I suggest we could do is I send you and Diana my email, or I get your contact and then I can connect you. The reason why I asked this question is because we were approached by a data firm based here in Johannesburg. They were actually compiling quite a significant amount of financial data, and it may not be uniquely relevant to insurance, but it's something that I'm sure if you talk to them, you can actually develop in that direction, and the issue of harmonization and comparability could be resolved. It's not technically impossible. Basically, that's what I'm saying. It's something that requires a conversation across sectors and across entities for it to be done. That's all I'm saying. So
I think the point is well made, and we can connect afterwards, because on the data side, that's where we can really build a coalition, right? Because the more accurate data is in the best interest of everyone in the ecosystem.
That's right. So should I actually just put my contact number on the chat here, and then you can reach out to me later. Yeah. So let me do that.
Thank you, George, and thank you very much, Leslie, for joining. So I will give you the words of the end. I don't know if you want to share with us before we close the webinar some feedback from your experience as the CEO of IFC and a company which is specialized in providing insurance projects to climate change effects. And then if you have anything you want to share with us before we close the webinar.
Thank you very, very much, Marina. So maybe just to really emphasize the role of insurance across 3 dimensions in the financial landscape. So firstly, insurance companies have a business model whereby they collect insurance premiums before they pay out claims. So there is a time lag between the collection of the premium and the payment of the claim, meaning that insurance companies have amassed significant balance sheets in the trillions of dollars globally. Insurance is the second largest institutional investor globally. This means, therefore, that we are able to invest our funds in a way that promotes resilience globally. This could be in renewable energy projects. This could be supporting the carbon transition. This could be in green bonds. So insurers have a huge role to play in terms of financial intermediation and allocation of investments. The second part to highlight is on the underwriting of risk. So in our case at the African Risk Capacity, we are the largest providers of insurance against extreme weather events on the African continent, meaning that when investors utilize our products, they're able to disaggregate the risk that they want to take and transfer the weather-related risk to us. So as an example, if you're investing in the agricultural sector, you are probably happy with commodity price risk for whatever commodity is being grown. However, you're not entirely happy to accept drought risk because that cannot be accurately financially modeled. So then you could transfer that drought risk to us as ARC, meaning that you can therefore take the risk that you're comfortable to take. This unlocks and enables much greater investment, across the spectrum, because then investors are able to really target the risk and the asset allocation that makes the most sense to them. And then finally, in the insurance industry, we've got expertise in risk management. So this includes understanding what the risk exposures are, quantifying what those risks are, and developing solutions for the transfer and the mitigation of those risks, which is then why the insurance industry is itself a crucial component in terms of creating the right climate for investment, enabling resilience, and de-risking and unlocking much greater investment across the value chain. And we are at the African Risk Capacity really proud to be playing this pioneering role on the African continent, and of course working closely with the many partners, including many of my friends that I see on the call today. So with those few words, I will stop here and thank you very much.
Thank you very much, Leslie. I remember for the very first webinar, a participant asked a question. He said, when we discuss about climate change, we only focused on the banking sector, but what about insurance? Does insurance have a role to play? And I think what you just said, Leslie, perfectly answered the question and summarized perfectly what we discussed during this webinar. So the key message is yes, African insurance do have a role to play, an important role, which is very well summarized by you, Leslie. And I will just point out the key message from this discussion, that we need to talk not only about the risk, because of course insurance is risk management industry, but we also need to think about the opportunity, because they are here. We need to think, we need to have a long-term perspective, not only a short-term perspective. And it's important to have partnership, because it's a very important issue, and no one can tackle the climate change Africa is facing by its own. So partnership are important, not only within the industry, but cross-industry between insurance and the banking sector, but also public-private sector. These partnerships are really important, and those are the importance of this partnership is well addressed with initiatives such as the AFAC, the V20, and the Nairobi Declaration on Sustainable Insurance, and the other initiatives we discussed during this webinar. So I want to thank again our speakers and panelists today, Diana, because we had the pleasure of having two Diana today, Kelvin, Leslie, and David for joining. And most importantly, I want to thank our participants for joining this webinar. And please stay tuned, because this is not the last webinar of the series, and we will come with more information regarding other webinars, with one in particular or addressing the regulatory issues, because the point was mentioned several times during this webinar. Thank you again, and enjoy the rest of your day, afternoon, evening, depending on where you are. Thank you very much.
Thank you. Bye.